Hello, everyone. My name is Danny Berkey, Director of Marketing at Park Avenue Capital. And it's a pleasure to be with you today for our second quarterly briefing webinar of the year. So for those of you that are new here, our quarterly briefing webinars is our form of market commentary. We host these on a quarterly basis. And our goal with this webinar series is just to address important planning and investment topics to keep you informed and empowered on your financial journey. It's also an excellent opportunity for you to gain firsthand knowledge from our seasoned professionals and ask any questions or concerns that you might have. And so our presenter today is our very own Chief Investment Officer, Chris Bremer, in his lovely pink shirt that I love today. Very summer and very summer. But for those of you that don't know Chris, he is a wealth of knowledge. He's our Chief Investment Officer, and he leads our investment team here at Park Avenue Capital, including our investment strategy and operations. Prior to Park Avenue Capital, he actually worked for 9 years at Northwestern Mutual's corporate headquarters, leading the team there responsible for their portfolio management and investment operations. So outside of that, Chris has also worked with other investment or wealth management firms. And I always like to put this fun fact out there. He also has worked with members of Congress on Capitol Hill on different finance and international relations legislative agendas. So it's an honor to have Chris with us. And before I hand it over to him, I'm just going to touch on a few housekeeping items. First, Q&A. We love for these sessions to be interactive sessions, so we highly encourage you to drop any questions that you might have in the chat feature or in the Q&A box, and we will address those either throughout or we have time reserved at the end for those questions as well. The number one question I always get is, will this session be recorded and shared? And the answer is yes. It takes us about a week to turn it around, but we are recording this session and we will share it out and also post it on our YouTube channel where you guys can access it afterwards as well. And then last but not least is we also love to get your guys' feedback from these sessions. So if you can hang on till the end, we launch a poll just gathering your feedback on today's topic, as well as any topics that you would like us to cover in the future. So we really value hearing that from you. So thanks in advance for that. And with that, I will go ahead and hand it over to Chris to kick things off for today.
Great. Thank you, Danny. Appreciate it. And everyone, thank you for joining the webinar. We appreciate the opportunity to talk more in depth about our investment philosophy and pull back the curtains on how we think about the world. Before I get into it, I would love if our clients could answer a couple poll questions for Park Avenue and our Northwest Mutual friends. I think I'd appreciate if you refrain from taking the poll, trying to get the best client information on their views as we can. And I think Danny will launch the polls in a moment.
First poll should be live. Getting your thoughts on technology. We'll leave it going here for a few minutes. 13, 15, 16. Great. I'm getting good participation.
Yeah, this is our theory, and right now, outside of letting Park Avenue Capital decide, the first two are split right down the middle, which is what I thought. So this will be a good topic for today.
Okay, kind of looks like we're still stalling, so I will end that poll. And Chris, do you want me to launch the other one as well?
Yeah, that'd be great.
Okay. All right, second poll.
Okay, this is very, very informative. It's another split as I expected, but with more concerned about SpaceX owning it than like it and want to own it. So that's kind of where we had landed. So this is going to be a great topic today. So technology is one of the more polarizing issues we get questions on. And honestly, if that's the most polarizing thing, we feel we're in a really good spot. Some clients do express apprehension about owning technology stocks, while others may have some technology familiarity, either in their professional or personal lives, and they desire to own more. So before we get into it, I'm going to address a couple questions I know that are on people's mind, that SpaceX and other potential IPOs. Then we will get into the technology discussion. None of this is a prediction about anything. What we're trying to establish is a framework, a way to think clearly when the headlines are very confusing. I'm going to set two caveats to begin. First, let me be clear about the purpose of our content. We are not here to talk anyone into more technology. We're not cheerleaders for it. We're addressing it because many smart people are nervous about it, and we think that worry is built on half of the picture. So my goal today is to just try to fill in the other half a little bit. Second, I'm going to mention our model portfolio implementation, not necessarily the specifics, but our model represents our investment committee's recommended allocation in the absence of any workplace restrictions, client preferences, or unique situations. Our model is not a mandate, it's a guidepost. We're not the CCP. Clients have freedom of expression. So first, let's address the most common SpaceX question, and that is index inclusion. So we talked about diversity of opinions. I think no investment is more polarizing than anything having to do with Elon Musk. Index inclusion has been a controversial topic. There's two key indexes that concern us, the S&P 500 and the NASDAQ 100. NASDAQ did update its rules to allow for quick entry for SpaceX and other large IPOs into the NASDAQ 100 after the listing, about 15 trading days, removing minimum float requirements and boosting the index weighting of companies with limited public traded shares. But note, this also serves to put a cap on the weight. So SpaceX will not be that big of a allocation in the NASDAQ 100. The S&P 500 is sitting this one out. On June 4th, the committee decided not to change their eligibility rules. And those rules do include a 12-month waiting period for trading and profitability requirements. So this may be another interesting topic a year from now. Recently, we sent out some information on IPOs in our client commentary. Here's what 35 years of IPO underperformance looks like. We went back and took all the IPOs by year and then looked at the returns from the date of IPO through the current period. And the best performing year, 44% of the IPOs have survived and outperformed through this time. So the point is that exciting stories are there, but not every good exciting story is an investment opportunity. They may, in fact, be mutually exclusive. Additionally, there is an ETF that tracks IPOs. It's called Renaissance IPO ETF. It has strong returns, 8.2% since inception 2013, but that's just over half of the S&P 500. Additionally, this ETF has double the S&P volatility and larger drawdowns. So you get more volatility, less reward. So that's something we see is often the case when chasing the new thing, and is generally why we don't like doing it. So I think with that, we'll get on to today's topic. So imagine some of us are old enough to remember 1999. And this is what a desk might have looked like. We had the tech boom, but we didn't have cell phones yet. We didn't have iPhones yet. We had floppy disks, we had slow computers, we had dial-up modems, choppy internet, and this pending disaster called Y2K. If you were there, you remember it. The Phantom Menace was the highest grossing film that year. Many of us, myself included, remember this very, very well. We also remember the ensuing technology bubble collapse from 2000 to 2002. I think this may be an anchor for many investors today, and it's completely rational, completely valid. Technology has led this market for years, and for some, it's been exciting. For others, it feels like the top, like 2000 all over again. And if you live through it, memory is very, very real. So I'm not going to tell you that there is no risk of a market pullback. There always is. Instead, we're going to start somewhere else. Again, in 1999, Harvard psychologists ran an experiment called Gorillas in Our Midst. Study was famous for a demonstration of intention blindness. Viewers were asked to watch a short video of people passing a basketball and counting the number of passes, focusing either on the team with the white shirts or the black shirts. Halfway through, a person in a gorilla uniform walked through the frame, faced the camera, pounded their chest, and then walked off. About half the viewers missed the gorilla entirely. They're not careless or inattentive. In fact, they were too focused. The investment industry is in the middle of its own gorilla problem right now. According to BlackRock, the average advisor is underweight technology and communications, sectors that include many of the biggest AI-related beneficiaries. Memory is real. You live through it from 2000 to 2002, you watch the technology sector lose most of its value, and you carried that with you. So the fear is not irrational. Today, a lot of investors are looking at things that can be tied back to this era. High spending, high valuations, bubbles, the prospect of bubbles, concentrations, mean reversion, and the feeling that we're in 2000 all over again. Meanwhile, there's a gorilla walking right through the middle again, and this gorilla represents the earnings of the big technology companies. So before we talk about that, I want to explain our technology exposure, just so we have a clear understanding. We seek to base our portfolio views on structural evidence, not tactical wins. Technology for us meets a high bar. Additionally, we believe in diversification. When you diversify globally, the effect is to reduce technology exposure. So for example, the broad international developed markets index, think Europe, Japan, Canada, has about a 12% allocation to technology. S&P has 38.5%. Mid and small cap stocks, again, part of diversification, have about 14%. Our allocation simply adds back some technology exposure to meet in the middle between what the global stock market has and what the S&P 500 has. The concentration of the US market is driven by 7 stocks. We've been hearing this for years. Like in politics and international relations, most misinformation comes with elements of the truth. The narrative isn't false so much as it is incomplete. Yes, tech has indeed had outsized contribution to US returns, but there's more. We can remove technology with the S&P 500 X Technology Index and compare it to the rest of the world, which we call the All Country World Index, ex-US. So that's everything else, all stocks in the world, minus the United States. The blue line is the S&P X Technology. Going back 20 years, even without technology, this index has handily beaten the world. I show you this because when people worry that the market is just a tech story, they're missing that baseline underneath, and that is that there's a broader-based non-tech S&P 500 outperformance going on. This is a US large company phenomenon which is accelerated and enhanced by technology, but is not exclusively technology. If investors could have avoided technology completely for this 20-year period in the S&P 500, they would have ended up with 33% less portfolio value over that time. The thing is, if you just did nothing, you didn't even have to have a view on technology. If you just hold the index, you didn't need to see it coming, but you owned it automatically. Here's the core of the matter. This graph is technology's share of the actual earnings of the S&P 500, not the price, it's the actual earnings contribution to the index. In 2005, that contribution was about 12%. Today, the technology sector accounts for a third and still climbing. So when you hear that technology is a big part of the index, yes, it is. But remember what it's really tracking. It's a big part because it earns a big part. The weight is just following the earnings. Earnings, furthermore, are high quality earnings. This graph shows operating margin. Tech, the blue line, runs about double the profitability of the index as a whole. And that gap has been widening, not closing. I recently listened to a podcast of Howard Marks. Many of you may know the name. He is an esteemed investor. He's been around a long time. He's known kind of as a value investor, and I'm paraphrasing, but he just said, the large hyperscalers, which are the big tech companies, are the best businesses he has ever seen. Now, what about all the spending they're doing? They're spending enormous sums building out AI. Won't that crush margins? It could. We don't know. But the best we can do is look at what has happened. The rising lines in this graph are indeed the spending of the big technology companies, and they're going straight up. The bars are the profit margins. And you can see that as the spending has increased, the margins have held, or they've even increased as well. And so while they're pouring massive amounts into the AI build out, they have been extraordinarily profitable as they've been doing it. It's generally not what a sector in trouble looks like. Will the operating margins remain elevated? Actually, we have no idea. That is certainly a risk. This chart helps explain why technology stocks have performed well. It cannot say anything about the future. While it's completely rational to fear 2000, let's look at the actual earnings. So both graphs show the same thing. These are we call relative charts. It's the information technology sector divided by the S&P 500, both for the price, the index price, and the earnings. When any line is going up, that means technology is doing better, and the line is going down, that means technology is doing worse than the index. The one thing we can see here is leading up to 2000, this is from 1997 to 2002. Leading up to the peak in 2000, the relative price more than doubled, while the earnings basically didn't go anywhere at all. And so while the investors were paying increasingly more for earnings that they may have thought were coming, but they never came. Now, if you look at the last 5 years, the blue lines represents the price. Again, it's been increasing higher than the earnings. This is true. But the earnings have also been increasing, especially from the bear market lows of 2022. The technology earnings have been increasing. So the industry in aggregate has been focused on the blue line, but not really relating it to the growth in earnings that's happening at the same time. Can the earnings line break down? Absolutely, it can. We're not here to promise durability. We can't do that. But as we sit here today, we are experiencing earnings growth and price growth at the same time. So if earnings are real, that raises a question. Why are so many smart, experienced people convinced that we're in a bubble? No, we're not claiming either way, that we're in a bubble or not in a bubble. Our vantage point is we cannot make these claims. The answer to us is the most human thing in the world. It's failure of imagination. It's happened before. It's not our fault. We're just conditioned. We're not conditioned to nonlinear thinking about the future. Here's an example. This one goes back, but I think it's interesting. In the early part of the 20th century, there was a relationship that held for decades, and that was the yield on stocks was always higher than the yield on government bonds and high quality bonds. 1958, that relationship flipped. And the people that were most certain that that was just a fluke and would revert back were some of the most seasoned in the industry. Peter Bernstein is a famous investor and writer, and he said decades later, said, I had two older partners who were grizzled veterans of the Great Depression who assured me that this was an anomaly that would, in a short period of time, correct itself, and the stocks would obviously have to yield more than bonds. I'm still waiting for that. Again, he wrote that decades later. Lesson isn't that the markets can correct and go down. Of course, they can and they will. They're frequent. That's not the risk. The risk here is making decisions based on a paradigm that has changed and no longer exists. There's another example. The nature of corporate value has inverted in one lifetime. And this is according to one prominent study. When I started a long time ago, if you were a stock analyst, there was adage, you go out and kick the tires of the companies you covered, to visit factories, see production lines, test the products. Decades ago, if you bought a company, you were buying its stuff, the buildings, the machines, the factors of production. Today, you're mostly buying ideas, software, patents, data, intellectual property, network effects. In other words, value creation has shifted from what can be touched to what can be thought. And that's a paradigm that I think is underappreciated and it's kind of hard to get our heads around. Here's another example of how certain smart people can be at the exact moment they are the most wrong. This is from the New York Times. Does anybody recall this piece? The headline is Confronting a Law of Limits. The argument is that Apple had simply gotten too big to grow much more. I posed a trick question. If you recall this piece, you have a great memory. It was written in 2012. It was written when Apple's market cap was unfathomably high at 425 billion. Today, it's 4.4 trillion. These numbers we just can't, we're not equipped to process and make sense of these numbers. And here's how the argument goes. Apple is running up against law of large numbers. Earnings growth must result in share price slowdown. Bigger than the gross domestic product of France and Brazil. We're going to come back to that. This is my favorite. Extrapolate to the future. You'd have to sell an iPhone to every man, woman, child, and animal and rock on the planet. That was awesome. So here's the thing. The Apple did in fact increase well beyond what that author was saying could never happen, and for a couple of reasons. One, it actually did grow without services, but back then there was no way to imagine the services contribution. There's no way to imagine the cloud infrastructure that was going to develop. Services hardly existed for Apple in 2012. Now it's 26% of revenue. Show this for Amazon too. There was no Amazon Web Services in 2012. Now it's 18% of revenue, and it's by far the largest, the most profitable business segment that in Amazon. So the pattern is that we can extrapolate what we know, but the future by definition is what you can't see, and you can't model what you can't see. So can anyone guess what this map represents? I hope you didn't think you just had 45 minutes here to sit and relax. Obviously, this is Europe, and it's the 15 largest companies in the S&P 500 paired with the corresponding rankings of the GDP of the European countries. 14 of those 15 pairings, the company's market cap is worth more than everything that country produces in a year. The only case where that's not true is the biggest one. The biggest economy, the biggest stock. Germany's GDP is slightly bigger than Nvidia's market cap, but not by much. But look, take a closer look. There's a pharmaceutical company in Belgium. Warren Buffett has retired to Sweden. There's a bank in Ireland. There's an oil company in the Czech Republic. This is a story about American enterprise. It's not just a tech story. Now, if your instinct is to claim that the comparison is an apples to oranges one, I agree, 100%. This is the argument that was made in the New York Times piece, and it's one I've heard skeptics make over the years, that accentuating the overvaluation of technology. The problem is, I think the mindset is different and has changed. When we think about manufacturing something, we think about a company in a country and how can that company that manufactures something be bigger than the country that it's in. That may be the wrong way to look at it. Manufacturing is a tangible thing. But an idea, well, an idea has no borders. Networks scale across geographies with very little friction among countries that share similar values. How do you put a valuation on that? It's a different way to think about how companies operate than just a manufacturing plant in a company. So I'm not showing this because I think tech is overvalued or undervalued. Just simply that the measuring stick that's been in our heads and that what we learn about evaluating businesses and companies may have been built for a world that has changed. One final example of challenges of imagination. The biggest companies have accumulated far more cash than is possibly imaginable, I think. And here's if these little guys on the left here are the S&P 500, you can see these massive gorillas are the big technology stocks. It's the scale doesn't even do it justice. The 75th percentile has 5.5 billion in cash. The median S&P company is 1.5. Look at this. The 90th percentile and the mean are the exact same. That means that these companies over here are lifting the mean so much. So the average, these companies on the right have 64 times the cash on hand as the median S&P 500 company. How do you even process that? It's hard. It's hard for professional analysts to do. As a result, there tends to be a damned if you do, damned if you don't dynamic applied. If you sit on cash, the companies get criticized for doing nothing. It's kind of a double standard because Warren Buffett often gets praised for sitting on cash as a prudent investor, not chasing things. If the companies buy back shares, they get scrutinized by the government. And at the moment they start investing to grow their business, they get criticized by the media and pundits for creating bubble-like conditions. So if we rely on the media for judgment, there's only one possible outcome investing their cash. It's that a bubble will occur that resembles a repeat of 2000. This is such a limiting perspective. We have no way of knowing any outcome, but we have a strong conviction that the spectrum of possibilities is much broader and the range of probabilities within that spectrum is much wider than the pundits would suggest. So what do we do with this? Where does that leave us? If the experts can't see the future, how can we? Well, here's the good news. And I think it's one of the most important ideas. You don't have to. The index does it for you. So have we seen a sector get too big before? Yes, the 2000 technology is a perfect example, but there are others. Following that era, we had the energy cycle of 2000 to 2008. Similar setup, sector that grew even more than technology has today. It's grown at a higher rate, but from a smaller base. And here's the energy story in one picture. The red line is energy's share of the S&P 500. Before around 2000, it was below 4%. It rose to a peak of over 15% in 2008. Now, watch what the blue line does. It's technology. Nobody would have guessed that technology would be the one up here, back here. Nobody would have guessed that. Technology overtook energy a couple years later and just kind of hung around for a while, but it showing signs of growth before it kind of exploded. As one driver faded, another emerged. Nobody decided that, or actually more accurately, millions of collective investors and traders decided that over the years. The crossover is the index mechanism working, and anyone who simply held the index was on board for both sides, the good and the bad of it. Now, I know what some of you are seeing, and don't worry, we see it too. The energy peaked here at 15%. What does that say about tech at close to 40%? That's fair. But wouldn't a steep fall in technology shake the market? There is no mathematical answer, but yes, it would. But here's where the structural view may or may not come into play. This is just a possible explanation, so take it for what it is. Energy's 15% allocation was riding a commodity boom. Oil price that went from $20 to over 140 during its peak in 2008. Technology's 40% allocation is riding an earnings boom because that's where the profits are. To us, and again, just a view, the earnings profile is structural. The commodity boom was cyclical. Energy was not the structural driver of the economy in the 2000s. It was a beneficiary. China's infrastructure build-out was the structural driver. Today, technology is a structural driver. How long earnings can go is a durability question that, again, we cannot pretend to answer. Takeaway is that the investment community seems to assume there's only one path for successful sectors to end. That's a free fall down. But when it comes to market history, that's merely one possibility of many. The energy example may be a warning, or you could flip it around and say it represents a reason why the current market allocation need not crash. It may just adjust over time. We don't know. Let's say you can call the top. Let's say you're allocated to a sector and you can call that top. You now have to call the next winning sector for the next cycle. There's 11 sectors with dozens of subsectors. Good luck with that. Industry will do that for you. But yes, with a lag, with volatility, with anxiety, consternation, but it will do the job that few investors in history can do consistently. Predict the next move. So the index doesn't actually make bets. It adjusts based on what market participants bet or how they allocate. It's easy to look at the market today and feel frightened that concentration at the top. There's always concentration at the top, different levels. But a total market index simply holds companies in proportion to the market's assessed value and earnings. Tech is a large share because those companies are the earnings engine of the modern economy. To deliberately own less of them out of fear is to bet against the structured economy itself. We can rationally be concerned about market concentration. The index didn't decide that it's gambling on technology. It holds the value based on the market's assessment. And tech became valuable because it's producing earnings. We can let the index do its thing automatically, and it will reallocate over time. That process is turbulent. That's a fact. I've been doing this a long time, and I can't tell you how many portfolios I have seen in the 25 years following 2000 and on that own substantial allocations to GE, Cisco, and Intel, among others. Here's just one example. Even including the 570% gain since last July, Intel since 2000 has returned 266% versus 700% for the S&P. Excuse me, 850% for technology. GE and Cisco are worse. So if we tactically allocate, we must decide when the torch is being passed from one company to another, from one sector to another. When you allocate to the market, the index does it for you. Imagine how freeing that is for decision making. So we've been looking at the top line of technology allocation. Now let's try to take a look underneath. This graph shows an estimated contribution of thematic business exposure to the top stocks over time. One note, this is a model decomposition. It does not represent a full set of factual data over time. The point is to illustrate the ranges of exposures among the largest companies today. You can see here, there's a wide range of exposures currently in the top companies today. Bloomberg Intelligence recently concluded, supporting our own research that we've done over the years, in a quote, and this is relating to the Mag 7. In fact, a case could be made that there are around 70 to 100 distinct entities that could be their own individual stocks. This is based on their collective acquisitions and the range of businesses and themes they operate in. Analyzing these companies can make the index's concentration seem less of a worry. One example, YouTube, owned by Google, company named Alphabet, is now estimated to have a worth that, if it were spun out, would be among the 20 largest US stocks. But interestingly, Google's revenue is only a minority of, YouTube's revenue is only a minority of Google's. Again, these are hard things to imagine and to process. Same thing could be done with many of these names. Every Mag 7 company has evolved into an expansive set of companies operating across these multiple industries, you can see. As a group, they have collectively acquired approximately 850 companies over their history. So don't override the index. The plan sets how much you own. We hold the leaders at market weight because betting against them is betting against what the market structure is today. And you just have to keep the discipline when things get rough. The gorilla experiment was interesting because after the video ends, the researchers rewound it and played it again, and people that didn't see the gorilla would say, some version of, whoa, I missed that? No way. And here's the thing. Once you see the gorilla, you can't unsee it. You watch it the whole way through after that. So if you just recognize that there's some connection with the underlying fundamental earning strength of the companies, that can help navigate your way through. Here's one more part of the experiment. The researchers found that whether you notice the unexpected thing depends on whether it looks like what you're already watching. So people who were assigned to watch the black t-shirt team saw the gorilla far more often because it matched what their eyes were tuned into. So we don't just miss things because we're distracted. We miss them because they don't resemble what we're looking for. Most pundits you see in the financial media are in a never-ending search for the next bubble. So of course, they will find evidence in all kinds of places. So we're not asking you to stop watching for risk. Keep counting the passes. That's vigilance, and it's healthy when we do it every day. We're just asking, widen the frame, because real risk to the plan was never the market or sector falling. Markets correct all the time. That is fully embedded into the financial planning scenario analysis our advisors do for clients. Rather, the permanent damage happens when fear convinces us to sell stocks on the way down or to override a system that already does the hard part for us, like making big bets away from the index. The system will hold weights according to what the market assigns to them over time. And sometimes that fades quickly and violently, other times quietly and unnoticeably. So takeaways are the earnings are real. This is not 2000. You don't have to pick the winners. The only real risk is overriding the plan. So with that, I think we will wrap up and open up to questions. Danny, I think you're on mute.
Sorry about that. Chris, thank you again for that presentation. Looks like we do have some questions rolling into the chat box. So yeah, we'll take a moment here. If anyone has any questions coming off of Chris's presentation, now's the time to ask those. Again, you can either do it in the chat or the Q&A feature that is available. So Chris, can you see those? Do you want to kind of tackle which ones? Otherwise, I can read those off if you aren't able to.
Make me put my reading glasses on.
Okay.
Let's see. Where do we start?
There's two that just came in.
Okay, if OpenAI and Anthropic don't perform, are able to charge what is needed to pay out hyperscaler deals, it feels like a massive correction will happen. Data centers are assuming they'll get paid X, but feels like Y, and we put back on build out. Okay. It could. The reality is we just don't know. There are other dynamics I think that probably are even bigger. And I hate to say it because I don't like it, but we're with the news of the last couple of weeks, there's government involvement now. We saw that the government restricted the Anthropic model called Fable, which I had just used for a couple of days. I thought was really good. So I think there's a new dynamic that is problematic if you don't like government interference in the markets. I think that's problematic. I don't know. We don't know. I haven't seen I know that both companies have filed to with the SEC, but we haven't seen the disclosures yet, or at least I haven't had. I'm not aware that they're out. So I honestly don't know, and I don't think that's a question that we can answer. I think there is some concern over some of these what's called circular deals. I think that goes both ways. I think right now cash is funding everything. And I also think there is some concern. A lot of that, again, is tied back to 2000, when a lot of the fiber optic companies were engaged in some of that kind of circular financing building. It was more of a build it and they will come scenario. This environment is completely different. And it's corroborated by the earnings reports of the companies over the last 8 quarters. They cannot keep up with the demand. So the companies are supply constrained in building out the demand that they're getting. So Google, for example, is spending a massive amount of money. Their backlog orders is bigger than what they're spending. And so there's this reason why the memory chips right now are priced so high. There's just not enough supply. And so right now it's a demand thing, and that didn't necessarily exist. So I don't know how to answer OpenAI and Anthropic until the financials come out, and we'll see. I mean, as far as I can know, OpenAI will be like SpaceX for the S&P 500. It probably will not make the index, at least, and even in a year, because as far as I can tell, they're losing a lot of money.
Yeah. Chris, I'll help tee you up a little bit. We've had quite a few come in. One that came in the chat is going forward, how often do you look at rebalancing index funds?
So we do rebalance. We right now for qualified accounts, meaning retirement accounts, IRAs, we are looking at rebalancing some of the tech exposure. That's something we're looking at over the next couple of weeks. So generally, we have a threshold of whether positions exceed the model target weight by a certain amount, and that's the threshold that we look at. So we're getting some of that with semiconductors, for example. So that's our process. On non-qualified accounts, which are accounts where you owe capital gains taxes, that's something where our advisors go to you, or in the review process will identify and assess your tolerance for gains and things like that. But we're always looking.
And there was a second part to that question. Do we look at newer, more aggressive funds, or do we stay, the terminology here is like older thinking index funds?
Older thinking. So the our mandate is, I guess the best way to describe this, in the absence of a view, for large stocks, for example, we would just own the S&P 500 index. Now, as tried to describe, we have a view, which is because we believe in diversification, because when you diversify your portfolios, you're reducing your tech exposure. And our view is that technology is the driver of earnings growth across all sectors. And we want to just add back some so we're closer to what the US market looks like and not closer to the international market, which has far less technology. So that view is expressed through core technology ETFs, not managers that pick stocks. So there's two ways to express that view. For many clients, it's called the Qs. It's the NASDAQ 100. It's a proxy for technology exposure. It's market cap weighted, so the largest companies are at the top. We also have a semiconductor ETF exposure. That's a modest exposure. That one goes back to 2020. And the thinking behind that one is, at the time, there was no AI as we know it. AI existed, but not at the retail level, not like the models that everyday users can use. And so at the time, gaming, there was some crypto, but supercomputing, autonomous vehicles were kind of the expected technology developments that didn't turn out to be the case. Our theory was we just wanted to own the engine of technology, which was the semiconductors. We didn't want to pick the winners, and we didn't want to pick the winning stocks. And that's actually worked out very well. And that's our philosophy. So we're not picking managers or hiring managers to pick them. We're just relying on the index technology diversified ETFs to complement the exposure that we have.
Great. I think I see a few questions here related around the same topic. One specifically, Chris, what are your thoughts over the last decade from 2000, 2010, in the S&P 500, and risks that can happen again with an overbuild and a high percentage of GDP tied to AI build out?
Uh, Yes, 2000, 2010 was a very challenging environment for sure. I think last decade would be for large cap growth. A lot of other asset classes did very well. And to be fair, let's be fair about this. The investment advisory industry before 2000 was not as diversified as it is today. A lot of investment advisors back then would have been concentrated large cap growth. And that was very, very painful. So this concept of open architecture and diversification was really born. There was institutional international investing, and there was some complements to that in the investment advisory space, but most of it was US large cap growth. After the technology bubble collapsed, open architecture, diversification was instituted, and that actually worked out tremendously well, because we saw all other asset classes do well during that time period. And so it was only a lost decade if you were concentrated. It was not if you were diversified. And that is a critical takeaway. It's a critical lesson for why we maintain diversification today. That doesn't mean, however, a lot of the lessons of that diversification, I think, are misapplied today. So I mentioned the China infrastructure build out. And this is one area we've looked at and studied extensively. The reason why emerging markets and international did so well was a confluence of events that coincided with the aftermath of technology bubble collapse. China was allowed into the WTO in 2000, started 2001. That unleashed a wave of investment and both retail investment into China and China's build out, infrastructure build out that would cause the energy and commodity cycle. That's over. That's over. That's not coming back. And that was a different era. That was a different world. That was a world where it was widely thought that bringing China in would allow them to open up. Um, Read any history today, that was never going to be the case. And so the world is a different place. So I think it's only lost decade if you were concentrated. If you weren't, then it turned out okay, and bonds did well. That's why we allocate stocks, bonds, and then we have a diversified array in front of us. Did that answer the whole question, Danny?
I think
Sorry,
so.
I could talk about the 2000s for a long time. And
Yeah.
obviously we had Alan Greenspan just passed away, and there's a big controversy around the conditions that led to the housing crisis. And so there's a confluence of a lot of things, and yeah, can it happen again? Yes, it can. And that's why we go through such a rigorous financial planning exercise where we take all inputs, how much you spend, when you retire, what your needs are in retirement, and we throw these through these simulations. We're trying to get at an outcome that works out for all of our clients to find that outcome where no matter what happens, and I will tell you, we've looked at the underlying assumptions that go into these scenarios. They are bigger than what happened then. They're more extreme than the Great Depression. And so if the financial planning analysis shows that you can weather that, that's what we're trying to look at. The best we can do with the portfolio is diversification. If you, by definition, bear markets are surprises. If you can foresee a bear market coming, the market would anticipate that beforehand. So that's possible. It's going to happen. I think the biggest risk, we identified this, I think, in one of our webinars last year. The amount of spending is real, and there is a risk that there's overspending. That is definitely a risk, and that's probably been our key risk to keep an eye out for. Right now, the spending is coming out of the earnings of the companies and their cash. Now, recently, the big companies are starting to issue debt. And Google just had another stock offering, a massive one. So these are things we're keeping an eye on. There could be overspending. But the demand right now is also insatiable, and that's not something that existed in 2000.
That's great. Yeah, Chris, there is a few questions that came in on just, how we are making decisions on our exposure to index in the coming months, but I feel like you kind of really just hit on that there with just our investment philosophy, and how we go about that. So I don't know if there's anything more you would want to expand on there.
No, I see there's mention of specific managers. So our philosophy or mandate is, I guess this is worth emphasizing. So we want to our implementation or investment implementation principles are control, transparency, and simplicity. And we want to have full control over the allocation, meaning, so there's mentions of, high profile managers. Some clients have had those in the past. We are not engaging in that now. We want to have index exposure. So for technology example, it's broad index exposure. They're not active bets, not picking stocks. It's just what the index does. And that helps with the expenses. So we are very proud of the fact that the embedded cost, that's the cost of the actual investments in the portfolio, is competitive as you'll see in our industry. We're very proud of that. We think that's a big deal. And so we can actually allocate where we have a view, if we need to, using low cost investments. That's a big part for us. Transparency is another one. So we want to know exactly what is in our investments and at all times. And with active managers, you don't know that until after the fact.
Maybe a fun one. Someone asked how we're using AI to in some of our processes with research and like our thought process going forward. Do we totally trust the advice that AI is giving us?
Yeah, no, we don't. We shouldn't. Absolutely not. There's a couple different ways. So um, we had an AI webinar, I think last year, yeah, maybe early last year. Since then, we've come a long way. So Northwestern Mutual has granted us an opportunity to engage with an AI provider in our systems. It's completely controlled. It's sealed off. And we are just started that process and using it for things like um, practice management for SOPs, standard operating procedures in our firm, and for doing some basic analytics. So, for example, I can throw in an earnings transcript now and get some basic analytics. So we are really excited about this. Again, controlled environment, which is great. Some of us do use AI on the side, not for work per se, but for testing out to see what it can do. So, for example, I have been using it for that exhibit with the slide on the. Let me go back to it because this was done with AI. I think that was pretty obvious, and I referenced Claude here. This you cannot create just by saying, "Hey, create me this chart." You have to know what it is that you're creating. You have to guide it to do something like this. So AI can be it's super powerful if you know what you're using it for. If you put in give me an investment allocation, it's going to give you what it thinks you want to hear. But with the real power comes from combining insight, expertise, and really thought out plan for what you're trying to accomplish. That can be really powerful. So we're excited about the opportunity that that Northwestern Mutual is rolling out to our practice and some others. And that is going to be, I think, something that will be ongoing and we'll be able to report back on it in subsequent webinars.
That's great. Maybe time for one more, Chris. There is one that came in. Do we have any concerns over the US debt? Um, and would that drive our thoughts on any changes from an investment standpoint?
The short answer is no, it's not driving any investment decisions. There's a longer answer. Do we have concerns? The smart thing to say is yes. That's what everyone says. I've been hearing these concerns for 30 years. So the historical precedent says that it seems like it's something to worry about. I think there are legitimate concerns. The debt level is high, obviously. Doesn't seem to have, it might have an impact. We don't know what it is. But I've been hearing the argument that this is a setup for extreme market conditions for a long time, and it hasn't happened. The best we can do with the portfolio is allocate thoughtfully for each client's own planning situation, risk profile. The biggest decision there is between stocks and bonds. There's different ways to look at it too. So there can be no simple answer. If you're concerned about it and you say, "Oh, I think you want to avoid stocks," okay, well then what are you going to invest in? Bonds, you have inflation running over 3% right now. Over the history of the markets, the most reliable inflation hedge is stocks. And it's not tick for tick in real time, but it is the most reliable over long cycles. Bonds yield less than inflation. So what are you going to do with that information? So I think there are legitimate concerns, yes. I would be more concerned about the governance of our federal government than I would about the debt right now. I would be more concerned about some of the systematic advantages that we've had as a country. For example, our alliance structure is probably the most powerful advantage that we've had over the decades, and that we seem to be breaking that apart. So I think there's lots of concerns, and there always are concerns. The market tends to look through those pretty well. So
That's great. Chris, with that, I think we can go ahead and wrap up for today. We'll go through these questions again, and if there's anything else that we want to add, we'll do follow up with you individually. At this time, we will launch our last poll just to gather your guys' feedback on today's session. And again, topics that you guys would like to see in the future. So I will launch that now. And with that,
There's another, I see someone's hand up. There's another question. I think the question is, I've heard numerous CEOs and business leaders say they're not seeing a return on their AI expenditures at this early stage. Does that indicate anything to you? Um, yes and no. So I think this has been challenging. So a lot of companies have gone into AI thinking that they have to employ it without really a good strategy for how to do it. That's what I'm really excited about what Northwest Mutual is. We have a really good approach, a good strategy for doing it. The problem is they're rolling it out and people don't know how to use it. The best I can understand, it's the best I can understand, I'm not an authority here, is that the advantages are accruing to individual workers, but not necessarily rolling to the top. So, and there are lots of challenges with AI. So for example, if I use AI, and let's say I used AI to build out my presentation today. Am I going to tell my leadership that? I'm going to be afraid to because, well, if AI can do your job, what do you need me for? There's a lot of that apprehension going on, or more realistically as well, I think there's a lot of employees who might use it, get some productivity enhancements, and they're afraid to say they are because now more expectations are going to be put on them. So there's all kinds of reasons why AI is struggling. Companies are struggling to see the benefits roll up to the top. I think the benefits now are accruing to some employees in their productivity and how they're using it, but it's a challenge at the corporate level. I think there's a misnomer out there. I think the AI is a terrific poor management um, uh, uh, laundering, and meaning it's easy to blame AI for reducing workforce. I think a lot of that is just a scapegoat for poor decisions that management has made right now. Um, what will be the primary considerations and decision points in shifting the mix of technologies, indices, funds in the coming months? I think right now uh, we're watching the technology developments. We're watching the earnings reports to see that demand is still there. So that's probably one. Eventually, if excess spending by the big companies is showing a lower margins and not earning something on it, that's a big thing. Let me give you a counter example. Last year, the in the spring we had I don't know what you call it, tariff tantrum when tariff day. We had a bear market. The market fell about 23% in a short amount of time last year. It's not that long ago. Everybody, seemingly all the investment world is recommending adding to international at the time. We looked at it. We took a hard look at it, and this was, I don't know if you recall, we actually did a webinar, I think, in the second quarter, called American Exceptionalism, that the narrative was American exceptionalism was dead. We didn't know either way, but we were questioning that narrative. And we ended up deciding that adding to international at that time would have just been like return chasing. And we didn't want to follow into that pattern. And in fact, had we done so from that period onward, international has underperformed significantly. So the counterexample is that doing nothing doesn't mean we're not considering things. We're always considering things. But our views are designed for not the next year, but for a multi-year horizon. And we're willing to change them if the evidence changes. But the data and the evidence has to indicate a clear break in that view.
great. So with that, Chris, we are about up on time. So I've had our poll live. With that, I'm good to wrap things up unless there's anything else you wanted to add.
That's it
Okay.
for me.
All right. Well, thank you,
Thanks, everyone.
everyone.
Appreciate it.
Yeah, thank you for joining. We'll leave this poll up. Chris, you're free to drop. I'll turn my camera off while we wait for additional feedback to come in through the poll. And yes, thank you for your time. Thank you for your feedback, and we will see you next time.
Thanks.